Have you ever pondered what separates a successful investor from a mediocre one? Let's delve into that subject by introducing a book that has been a cornerstone in the world of investing. The book in question is The Intelligent Investor, penned by the unrivaled Benjamin Graham. Benjamin Graham, a figure of immense importance, wasn't just an accomplished investor, but also a profound educator. He is often referred to as the father of value investing, and his teachings have shaped the investment strategies of many successful investors, including the renowned Warren Buffett. Now, what does it mean to be an intelligent investor? It's not about being the smartest in the room or having the most insider information. It's about investing with a margin of safety. But what does that mean? Well, in the simplest terms, it means buying into companies at prices that are significantly below their intrinsic value. It's about ensuring that even if things don't go as predicted, your investment is safe. An intelligent investor is aware of market fluctuations but doesn't let them dictate their decisions. They understand that the market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. They know that the market price merely reflects the mood of the crowd, not the true value of the business. Does this mean an intelligent investor never makes mistakes? Of course not. However, they learn from their mistakes, they adapt, and most importantly, they don't let their errors drive them into making irrational decisions. An intelligent investor doesn't panic when the market goes down, nor do they get overly excited when it goes up. They are patient. They are disciplined. They are not swayed by the crowd or their emotions. They invest based on logic and sound principles. An intelligent investor doesn't seek to outsmart the market. Instead, they aim to maintain a steady course of buying good quality businesses at reasonable prices and holding on to them for the long term. And that, my friends, is what sets apart a successful investor from a mediocre one. An intelligent investor is patient, disciplined, and not driven by emotions but by logic and sound principles. Do you know the difference between investing and speculation? Let's dive into the first principle of the intelligent investor, which beautifully differentiates between the two. If you think they're the same, you're in for a surprise. Investing and speculation, though often used interchangeably, are worlds apart. An intelligent investor, as Benjamin Graham would say, focuses on the long-term growth and safety of capital. It's like nurturing a seedling, providing it with the right conditions to grow and patiently waiting for it to become a mighty tree. Investing is about deliberate, well-researched decisions. It's about understanding the business behind the stock, its industry, its financials, and its potential for growth. It's about buying a piece of a business, not just a stock ticker. It's about being patient and letting compound interest work its magic over time. On the other hand, speculation is a different beast. A speculator chases quick profits, often relying on market trends and hearsay rather than solid research. It's a high-risk, high-reward game akin to gambling. Speculators buy a stock not because they believe in the business, but because they believe someone else will pay more for that stock in the near future. While speculation can lead to incredible gains, it can also lead to disastrous losses. It's unpredictable and volatile. It's not for the faint-hearted or the ill-prepared, and more often than not, it's not the path to long-term wealth. So ask yourself, are you an investor or a speculator? Do you have the patience to wait for your investments to grow, or are you constantly chasing the next big thing, the next hot stock? Remember, the stock market isn't a get-rich-quick scheme. It's a tool for building wealth over time. It rewards those who are patient, disciplined, and methodical. Investing is not about getting rich quick, it's about getting rich slow. So let's slow down, do our homework, and make intelligent investment decisions. After all, Rome wasn't built in a day, and neither is lasting wealth. How do you protect your investments from potential losses? This is a question that keeps many investors awake at night. But the answer is simpler than you might think. It's all about the margin of safety, the second principle of the legendary book, The Intelligent Investor. Imagine this. You're about to cross a bridge, but you're not sure if it can hold your weight. Would you risk it? Probably not. That's the same principle you should apply to your investments. It's all about ensuring that the bridge, or in this case the investment, can hold more than what you're putting into it. This principle is what we call the margin of safety. The margin of safety is the difference between the intrinsic value of a stock and its market price. In simpler terms, it's buying stocks for less than they're worth. This ensures that even if things don't go as planned, the potential downside risk is minimized. It's like having a safety net, ready to catch you if you fall. The beauty of the margin of safety is that it doesn't require you to predict the future. Instead, it's about understanding the present. It's about knowing the true value of a stock regardless of its current price. By investing in stocks below their intrinsic value, you're not only protecting your investment but also setting yourself up for potential profits. But how do you determine the intrinsic value of a stock? It comes down to thorough analysis and understanding of a company's fundamentals, such as its earnings, assets, and liabilities. It's a meticulous process, but one that's well worth the effort. In the volatile world of investing, the margin of safety serves as your protective armor, shielding you from potential losses. It's not about avoiding risk altogether, but managing it effectively. It's about making informed decisions, not based on speculation, but on solid facts and figures. So the next time you're about to make an investment, remember the bridge analogy. Ask yourself, does this investment have a strong margin of safety? If the answer is yes, then you're on the right track. The margin of safety is the secret sauce of the intelligent investor. Do you let the market dictate your investment decisions? If you answered yes, then it's time to introduce you to a fascinating character named Mr. Market. This concept comes from the third principle in the classic investing book, The Intelligent Investor. Mr. Market is a metaphorical character who is your business partner in the world of investing. He's an emotional fellow, swinging wildly between unbounded optimism and deep pessimism. Some days he'll offer to sell his share of the business for a high price, convinced that the future is bright. Other days he'll offer to buy your share for a low price, certain that doom and gloom are just around the corner. Now you might be wondering, what does Mr. Market have to do with my investment decisions? Well, that's the crux of it. You see, Mr. Market represents the fluctuations of the stock market. His mood swings are the market's ups and downs. An intelligent investor doesn't let Mr. Market's whims dictate their decisions. Instead, they use Mr. Market's mood swings to their advantage. When Mr. Market is optimistic and prices are high, the intelligent investor might sell. When Mr. Market is pessimistic and prices are low, they might buy. The key here is to remember that price is what you pay, but value is what you get. Just because Mr. Market offers a price doesn't mean it reflects the true value of the business. An intelligent investor makes decisions based on the intrinsic value of a business, not the price tag Mr. Market slaps on it. So the next time you're about to make an investment decision, remember Mr. Market. Don't let his mood swings sway you. Instead, use his emotional instability to your advantage. Be patient, be disciplined, be intelligent. Mr. Market is there to serve you, not to guide you. And that, my friends, is how you take control of your financial future. So, what does it take to be an intelligent investor, you may ask? Well, as we have journeyed through the principles of Benjamin Graham's The Intelligent Investor, let's reflect on the key takeaways. First, we've learned that investing and speculation are two very different beasts. Investing is about analyzing the intrinsic value of a business, buying at a reasonable price, and holding for the long term. It's like planting a tree and patiently waiting for it to bear fruit. Speculation, on the other hand, is more akin to gambling. It's a game of chance, where short-term price movements take precedence over long-term value. The second key point we've explored is the margin of safety. This golden rule of investing is about buying assets for less than their fundamental value. It's about having a cushion to absorb the impact of unforeseeable events or miscalculations. It's about ensuring that even if things don't go exactly as planned, you're still protected. And then we come to the concept of Mr. Market. This imaginary character is a reminder that the market can be irrational and volatile in the short term. It's an allegory that teaches us not to be swayed by market mood swings, but to see them as opportunities. When Mr. Market is pessimistic, it might be a good time to buy. When he's overly optimistic, it might be a time to hold or even sell. These principles may seem simple, but they require discipline, patience, and a clear understanding of your investment goals. They urge us to focus on the fundamentals, ignore the noise, and stay the course. They encourage us to be cautious when others are greedy, and be greedy when others are fearful. Remember, investing isn't about beating others at their game, it's about controlling yourself at your own game. So, are you ready to apply these principles and become an intelligent investor? It's a journey worth embarking on.